Hi everyone. Put together this brief presentation just to focus on the 5 evaluative criteria for taxation. It's important information because obviously we are going to be referring back to this after we discuss each of our 3 main forms of taxation, including property, sales, and income taxes. So it's important information to hold on to and to at least keep in the back of your mind for a while, because we're going to go back and use this to tie all of our 3 different types of taxation together. And so very quickly, I'd like to introduce you to the 5 main evaluative taxation criteria. The first one we're going to look at tonight is burden distribution. So with burden distribution, we are asking the very basic question of who bears the burden of taxation? So who pays the tax? We have 2 different principles that we can use for burden distribution. The first one is an ability to pay principle, and the second is benefits received. An ability to pay principle is something that we will use if we're doing something such as, say, the income tax. Income tax, we will index an individual's taxation liability by their ability to pay. And so we'll use their marginal tax bracket to determine the tax rate they'll pay in income taxation. Another example of an ability to pay type of tax is the property tax. So with the property tax, we will use a wealth-based tax where we'll use the value of your home as an indicator of your wealth. The higher the assessed value of your home, the more capable you are of paying taxation. So therefore, those individuals with a higher assessed value to their homes will pay higher amounts of property taxation. So we see ability to pay principle used primarily in the income tax as well as the property tax. Contrast that then to sales taxes. Sales taxes, we use a benefits received principle. So we will index the tax burden to the benefit that someone receives from consuming some type of a good or a commodity. So again, we're not going to ask someone how much money they make when they purchase a candy bar. The amount that they pay in taxation will then be rolled into the price of that candy bar. So burden distribution, who pays, either based upon an ability to pay principle or a benefits received principle. The second criteria we're going to look at is equity or fairness. So with equity and fairness, we have 2 different dimensions we're interested in here, either horizontal equity or vertical equity. With horizontal equity, we'll ask the question, are 2 similar taxpayers treated the same for the purposes of taxation? So, in terms of the property tax, if we have 2 identical homes located next door to each other, completely identical, they have the same square footage, they were built in the same year, they have the same amenities, we would expect that those 2 homes will have exactly the same property tax bills. That's true in many states. In the state of California, that's not so true, because here in California, we reassess the value of property whenever that property changes hands. So if you have the house on one side was purchased in 1975, the house next door to it was purchased in 2015, the house that was purchased in 2015 will have an exponentially higher property tax bill than the 1975 house. That's a classic example of a violation of horizontal equity. 2 similarly situated taxpayers who are actually paying very different property tax bills. In addition to horizontal equity, we also try and maintain vertical equity. And with vertical equity, this is where the issue of progressivity and regressivity comes into play. So with vertical equity, we would hope that individuals who have more of an ability to pay will pay higher burden in taxation than those with less of an ability to pay. That's referred to as a progressive form of taxation. Income taxes, with the use of a graduated marginal tax bracket system, is designed to give us progressive types of income taxes. Contrast then that to a property tax, especially the way in which it's used here in California. That tends to violate the idea of progressivity. And it tends to be a relatively regressive tax, especially for that individual who purchased the home in 1975. Another tax that relates very well to the idea of progressivity versus regressivity is the sales tax. So with the sales tax, if we are taxing all goods, including the staples of life, like food, clothing, shelter, if we are taxing those all at the same rate, regardless of the individual who is purchasing those commodities, we are going to have a regressive form of taxation. because those individuals at higher income levels have more disposable income, after they have purchased the staples of life than individuals at lower income levels. And so that would end up being a regressive form of taxation. We can take a regressive tax and we can try and make it more progressive in nature through a series of commodity-based exemptions, through a series of circuit breakers, but we will talk about those commodity exemptions and circuit breakers in a future session. Our next criteria is adequacy, and this is a very basic, simple one, that the tax that we are utilizing must generate an adequate yield. The yield is the amount of tax revenue that we are generating from that given form of taxation. Most of our three major forms of taxation, property, sales, and income, all tend to be relatively adequate in terms of their yield. Adequacy is going to be a function of the tax capacity of the jurisdiction. So a property tax will probably generate an adequate yield if that jurisdiction has a high tax capacity. In other words, if that jurisdiction has a sufficient assessed valuation of property. But at the very basic level, a tax must be able to generate an adequate yield to then pay for the expenditures that we are proposing in our budget. The next criteria that we look at is collectability. Some taxes are inherently easier to collect than others. The old adage here is that the more taxpayer active a tax, the less able we are to collect that tax. Now, in terms of taxpayer active versus taxpayer passive taxes, we look at the role that the taxpayer plays in actually calculating and remitting the tax owed to government. In a taxpayer active type of tax, that taxpayer will take a very active role in calculating the tax liability and then paying the tax liability. In a taxpayer passive type of tax, the tax calculation is already done for the taxpayer and the collection is done by a third party, oftentimes a vendor. The sales tax is a great example of a taxpayer passive tax. You purchase a good, the tax is then rolled into the price of that good, the vendor collects that tax, the vendor then remits that tax to government. There is usually an administrative fee that's attached to that to try and induce and incentivize the collection of that tax by a vendor. The fewer individuals or organizations you deal with, the better in terms of tax collection. So with the sales tax, since it's being collected by vendors, governments only have to deal with a very limited number of vendors as opposed to hundreds of thousands or millions of individual taxpayers. So the more taxpayer passive tax, like a sales tax, the more likely it is to be able to collect that tax. Now, different taxes have different collection rates. I would point out to you, and we'll talk about this in a future session, the property tax typically is collected at about a 97% rate, meaning that jurisdictions are usually able to collect at least 97% of the property tax levy that is owed to them. If a jurisdiction is not collecting at least 97% of the tax, that usually is a red flag, especially in terms of credit and bond ratings, and will result in a lower credit rating for the government than if it's able to collect at least 97% of the levy owed. And then our final criteria here is economic effect. And this is really a two-way street. So with economic effect, we ask the question, how does the tax affect the economy? And the second street is then, how does the economy affect the tax? So it's a two-way street. The first question, how does the tax affect the economy? What we're looking for here is we're looking for any evidence of economic distortion. So does increasing the sales tax distort economic activity? Well, it probably will if it's a very elastic type of demand for that good or that service. So the more elastic demand for a good, the more likely there will be economic distortion. The second street then is, how does the economy affect the tax? So how do fluctuations in the economy affect the amount of tax revenue we're generating? Some taxes are relatively well insulated from the economy. Some taxes are very closely tied to economic fluctuations. One example of a tax that's very closely tied to economic fluctuations is, of course, the sales tax. So as we have an economic downturn, a downturn in the economy means that there's less money out there for people to go out there and spend and to buy commodities. The less money out there to spend, the less transactions there are, the lower the amount of sales tax revenue we're going to get. You can contrast that to something like the property tax. Historically, with the exception of the most recent downturn in the housing market that has now turned around in the past couple of years, the property tax is relatively well insulated from economic fluctuations. The property tax tends to be a very stable source of revenue. Governments can count upon it. Governments can predict future revenue amounts pretty well with the property tax. And that property tax rates tend to be relatively stable, and the assessed value of property tends to increase incrementally over time. So property tax, you won't see a whole lot of economic effect. Sales taxes, you will see a great deal of economic effect, and you can potentially see a great deal of economic distortion. So those are our five main evaluative criteria for taxation. Again, keep those in mind. As we move through our three different types of taxes, property, income, and sales taxes, we will reference these five evaluative criteria, and we will use them to then tie our discussion of the three forms of taxation together. In our next session, we'll look at property taxes, and we'll talk about the way in which property tax works, advantages and disadvantages of the property tax, and then how the property tax then relates to these tax evaluative criteria.